Picture this. You're scrolling through your phone on a Tuesday evening, half watching something on TV, and you come across an article about someone who invested during the 2008 financial crisis and turned $50,000 into nearly $600,000. And your immediate reaction is, well, that's great for them. But I wasn't in a position to do that. I didn't have $50,000 lying around. And even if I had, I would have been terrified to invest it when the entire financial world appeared to be collapsing. You close the article. You go back to scrolling. And somewhere in the back of your mind, the thought settles in, those kinds of moments are for other people. People with more money, more knowledge, more confidence. Not for someone like you just trying to keep up with bills and maybe one day build something that actually lasts. Here's what I want to say to that thought before we go any further. You are wrong. And by the end of this video, I'm going to prove it to you with numbers, with history, and with a story that's quietly unfolding right now that most people have no idea is happening. Hi, you can call me Miss Money, and I spend way too much time thinking about the moments in history when ordinary people had the chance to build extraordinary wealth, and why most of them missed it not because they lacked money, but because they lacked information. If you're someone who works hard, does everything you're supposed to do, and still feels like real wealth building is just slightly out of reach, make sure you hit the subscribe button and give this video a thumbs up if it helps you out. I post new content every single day, and you're going to want to be here for this. Because today, we're talking about something that has happened only a handful of times in modern economic history. And right now, quietly, while most people are distracted by daily headlines and short-term noise, it is happening again. Let me take you back to March 9th, 2009. The S&P 500 had just closed at 676 points. Lehman Brothers had collapsed 6 months earlier. Retirement accounts had been cut in half. Newspaper headlines were using phrases like, worst economic crisis since the Great Depression. The mood was not cautious optimism. The mood was genuine fear, the kind that makes people pull their money out of everything and put it under a metaphorical mattress. Most people did exactly that. But there was a school teacher, let's call her Margaret, who did something that everyone around her thought was completely irrational. She took $50,000 she had been saving for a house deposit and invested it in a simple S&P 500 index fund. Her friends thought she had lost her mind. Her family begged her to wait until things stabilized. She ignored all of them. Today, that $50,000 investment is worth approximately $590,000. She didn't pick individual stocks. She didn't have insider information. She didn't have a finance degree or a Bloomberg terminal or a hedge fund manager on speed dial. She simply recognized a moment and acted on it while everyone else was paralyzed by fear. Now here's the thing. I'm not telling you this story to make you feel bad for not investing in 2009. Most of us weren't in a position to, and frankly, sitting in the middle of a financial crisis with $50,000 in savings and the confidence to invest it when everything looks like it's on fire takes a specific kind of psychology that most people simply don't have access to in that moment. That's not a character flaw. That's being human. I'm telling you this story because the conditions that made Margaret's decisions so spectacularly correct, they are forming again, right now, in a completely different way. And this time, the window isn't just a single terrifying moment at the bottom of a market crash. This time, the window is 25 years wide. Here's what most people don't realize. Between 2010 and the end of 2024, the United States went from approximately 8.4 million millionaire households to almost 24 million. The country added over 15 million new millionaire households in just 14 years. To put that in perspective, 15 million households. That's roughly the entire population of the greater New York metropolitan area crossing the $1 million threshold in less than a decade and a half. Where did all these new millionaires come from? This is the part that should genuinely surprise you. The vast majority weren't entrepreneurs who sold companies. They weren't executives with enormous stock option packages. They weren't people who got lucky on a single investment. According to research by Ramsey Solutions on over 10,000 millionaires, 79% were self-made, with no inheritance. Only 31% averaged $100,000 or more in annual income throughout their careers. The average millionaire reached that status after 28 years of consistent behavior.
Teachers.
nurses, accountants, small business owners, regular people who simply kept investing consistently through their retirement accounts and index funds, while everyone else panicked, waited for better timing, or spent their money performing a version of wealth rather than building it. That's the real story of the 2009 to 2024 wealth creation event. And it's about to be dwarfed by what's coming next. The number is $124 trillion. I'm going to say that again, $124 trillion. According to research from Cerulli Associates, published in 2025, that is the amount of wealth that will change hands over the next 2 decades. This is what economists and financial researchers are calling the Great Wealth Transfer. And it is, without any exaggeration, the largest movement of wealth in recorded human history. Nothing in the last 100 years comes anywhere close. Let me give you a sense of the scale because $124 trillion is a number that doesn't land naturally in the human brain. It exceeds the total annual economic output of every country on Earth combined. It is more than 5 times the current U.S. national debt. It represents wealth accumulated across roughly 80 years of American economic expansion, and it is about to begin moving from one generation to the next. Here's the mechanism. Baby boomers, those born between 1946 and 1964, currently control approximately 52% of all wealth in the United States. That's roughly $78 trillion concentrated in a single generation. The youngest boomers are in their early 60s right now. The oldest are approaching 80. Over the next 2 decades, this wealth will transfer to their children, their grandchildren, and to charitable organizations. Generation X stands to inherit approximately $39 trillion. Millennials will receive approximately $46 trillion. Even younger generations will begin receiving significant amounts as the transfer accelerates through the 2030s and 2040s. Now, you might be thinking, okay, that's interesting, but I don't come from a wealthy family. I'm not expecting a life-changing inheritance. What does any of this have to do with me? This is where it gets really interesting. The opportunity here isn't primarily the inheritance itself. Most of the wealth being transferred is concentrated among a small percentage of households. Cerulli estimates that approximately 62% of the wealth being transferred comes from high net worth and ultra high net worth households, which represent only about 2% of all families. Most people won't receive transformative inheritances. But here's what almost no one is talking about. It's not the inheritance that creates the wealth opportunity for ordinary people. It's what the movement of $124 trillion does to the entire economy around it. When trillions of dollars flow into investment accounts, asset prices rise, benefiting everyone who's already invested, even in small amounts. When heirs purchase property, real estate values in those areas appreciate, benefiting existing owners. When inherited capital funds new businesses, job creation accelerates. When that much money is moving through an economy, it creates ripple effects across every asset class simultaneously. Think about it this way. Imagine a river that's always been a steady stream. Now imagine someone opens a dam upstream and a vast additional flow of water starts moving through. The water level rises. The whole landscape changes. You don't have to own the dam to benefit from the rising water. You just have to be in the river. The last time something even remotely comparable happened was after World War II, when returning soldiers used educational benefits to earn degrees, used housing programs to buy homes, and built the middle class that defined prosperity for the following half-century. That wealth creation event produced the baby boomers. The boomers are now the ones transferring their wealth. We are watching history repeat, at a scale that makes the original look modest. Look, I want to be direct with you about something because I think the financial content world does a lot of damage by making moments like this sound like easy, automatic money. It is not automatic. It never has been. The people who became millionaires after 2009 stayed invested through some genuinely terrifying moments. The European debt crisis in 2011, a major government shutdown in 2013, a full-blown trade war in 2018, a global pandemic in 2020 that caused markets to drop 34% in 5 weeks, a significant bear market in 2022, At every single one of those points, there were completely rational-sounding arguments for why you should sell, wait, or pull back. The people who listened to those arguments missed the recovery. Goldman Sachs research shows that missing just the 10 best trading days in the market since 2009 reduces annual returns from approximately 17% down to approximately 12%. Missing the 25 best days cuts returns nearly in half. Here's the brutal part. The best days in the market almost always occur during the most volatile periods. The moments when fear is highest are typically the moments when the greatest gains happen. The psychology required to stay invested when headlines are screaming at you to get out, that is the actual skill. Not stock picking. Not timing. Staying. And this is the part that trips most people up because our brains are not naturally wired for it. We are wired for threat response. We are wired to interpret falling numbers as danger and to act on that danger by removing ourselves from it. The entire history of successful long-term investing is essentially a story of people learning to override that instinct. Let me show you what the mathematics of staying invested actually looks like, because I think concrete numbers matter more than inspiration. Someone who invested $500 per month in a broad market index fund starting in January 2009, just consistently, every month, regardless of what the headline said, would have accumulated over $250,000 by early 2026. Not counting any employer contribution match. Now, apply the same logic to the great wealth transfer window. Consider someone who is 35 years old today and invests $500 per month in diversified index funds for the next 25 years, roughly the duration of this wealth transfer period. At the historical average market return of 10% annually, that $150,000 in total contributions becomes approximately $665,000. Even at a more conservative 7% return, it becomes approximately $405,000. And here's what most people don't realize about those projections. They don't yet account for the potential tailwind of $124 trillion in additional capital flowing into the economy. If economic growth runs even 1 percentage point above historical averages because of increased capital deployment, that 7% becomes 8%. The outcome shifts from $405,000 to approximately $475,000. Increase the monthly contribution to $1,000 as your career progresses, and the numbers scale accordingly. At 10% returns over 25 years, you're looking at $1.33 million. Regular people reaching millionaire status through consistency and time, not luck, not genius, not insider access. That is the opportunity sitting in front of you right now. Now, here's what most people don't realize about wealth creation events. They never feel like wealth creation events while they're happening. March 2009 felt like catastrophe, not opportunity. The people sitting at kitchen tables with their saving statements, watching their balances get cut in half, were not thinking, "This is a once-in-a-generation buying opportunity." They were thinking, "I have to protect what I have left." That is a completely understandable response. It is also why most of them miss the recovery. The great wealth transfer doesn't feel dramatic right now either. There's no single visible crisis, no headline-grabbing crash. There's just a gradual, massive, quiet movement of capital, documented in research reports that most people will never read, that is already underway and will continue for the next 2 decades regardless of what happens in any particular year. The S&P 500 crossed 2,000 in 2014. It crossed 3,000 in 2019, 4,000 in 2021, 5,000 in early 2024, 6,000 in late 2024, 7,000 in January 2026. Every single crossing point generated commentary about overvaluation, about the rally being unsustainable, about this being the wrong time to invest. The people who ignored that commentary and kept contributing built wealth. The people who waited for clarity, for stability, for a better entry point, they gave up years of compounding while capital continued to flow. The best time to plant a tree was 20 years ago. The second best time is right now. I know that sounds like a cliché. The reason it's a cliché is because it keeps being true. This is where it gets really interesting, because the great wealth transfer doesn't just create a rising economic tide. It also creates specific, identifiable opportunities in particular sectors and areas that are worth understanding. Research from Bank of America shows that younger investors have dramatically different financial preferences than the generation currently holding most of the wealth. 72% of investors between ages 21 and 43 believe it's no longer possible to achieve above-average returns with traditional stocks and bonds alone. This represents a generational shift in investment philosophy, and when $46 trillion reaches millennials and $39 trillion reaches Gen X, that philosophy will redirect enormous amounts of capital into specific areas. Artificial intelligence infrastructure is already capturing extraordinary investment in 2026. Clean energy, healthcare innovation, digital assets. These sectors are positioned to capture disproportionate shares of redirected wealth over the coming decades. This doesn't mean abandoning broad market investment. It means understanding that the composition of where capital flows is shifting and positioning with awareness of that shift. Real estate is another area where the transfer will create both opportunities and disruptions. Demand will increase as wealthier heirs seek to purchase property. Supply will increase as inherited properties enter the market. Markets where younger generations want to live, cities attracting technology and creative industries, may see intensified competition as newly wealthy buyers enter. Markets losing population may see the opposite. Geographic awareness. If you have any flexibility about where you live or where you invest in property, translates directly to financial outcomes over the next 2 decades. And here's a dimension that almost no one is talking about. The professions and businesses that exist to facilitate wealth movement are about to grow enormously. Financial planning, estate administration, tax advisory, wealth management, legal services handling estate matters, real estate transactions. When $124 trillion changes hands, entire industries scale up to manage the process. People who develop skills and careers in these areas, or who build businesses serving the people managing this capital, will find robust opportunity throughout the transfer period. The wealth movement doesn't just benefit heirs. It benefits everyone positioned around it. Let me talk about the psychological dimension of this for a moment, because I think it explains a lot about why most people miss wealth creation events even when the information is completely public. Here's what most people don't realize. In 2009, the information Margaret used to make her decision was available to everyone. The market bottom was visible to anyone with a brokerage account. There was no secret knowledge. The $124 trillion wealth transfer is documented in research reports that are publicly available to anyone willing to read them. There is no hidden intelligence here either. Yet in both cases, most people fail to act.
Why?
In 2009, fear was the barrier. The emotional experience of watching assets fall made action feel reckless even when the rational case for action was completely clear. Today, the barrier is different. It's distraction and short-termism. The wealth transfer is a 25-year event. Human attention and financial media are both optimized for 25-hour cycles, not 25-year ones. The thing that gets clicks is today's market movement, today's economic data release, today's crisis. The quiet, structural, multi-decade reordering of $124 trillion doesn't compete well for attention. This is actually good news for you. The fact that most people aren't positioning for this means the opportunity is less crowded. The fact that the timeline is 25 years means you don't need perfect timing. You don't need to identify the single right moment the way Margaret identified March 2009. You just need to be consistently participating as the process unfolds. The people who became millionaires after 2009 weren't smarter than everyone else. They were simply willing to act on information that was available to everyone. The same will be true of the people who benefit most from the wealth transfer. They won't have had access to any special knowledge. They'll simply have been paying attention and willing to act. So what does acting actually look like? I want to give you something concrete, because a video that ends with "the opportunity is real, good luck out there" is not a video, it's a pep talk, and you deserve more than that. First, maximize your tax-advantaged accounts. The $124 trillion transfer will be partially captured by people whose investment accounts grow alongside the economic expansion it generates. If you have access to an employer-sponsored retirement account, contribute at minimum enough to capture whatever match is offered. That is an immediate 50% to 100% return on that portion of your money before a single investment is made. Then increase that contribution. For 2026, the 401k contribution limit is $23,500, with an additional $7,500 catch-up contribution available for those 50 and older. Maximize an individual retirement account on top of that if possible. These accounts allow wealth to compound without annual tax drag, which, over 25 years, is a significant additional advantage. Second, maintain broad exposure to equity markets through low-cost index funds. Don't try to pick the individual sectors or companies that will benefit most from the transfer. Nobody knows with precision where the capital will flow. Own the entire market through a diversified index fund. As the wealth transfer moves through various asset classes, broad exposure ensures you participate in aggregate growth rather than betting on a single outcome. Third, build savings specifically for opportunistic deployment. The wealth transfer will not be a smooth, uninterrupted rise. It will be punctuated by recessions, corrections, and crises, each of which will be presented by financial media as a reason to reconsider your positions. In reality, each of those moments is a version of March 2009. Having cash reserves available when others are being forced to sell, when prices are temporarily dislocated from underlying value, provides enhanced returns during the inevitable disruptions. Fourth, extend your time horizon deliberately. Think in decades, not quarters. The transfer spans 25 years. Short-term market movements matter far less than long-term participation. Every time you feel the urge to react to a headline, and you will, because that urge is human and persistent, come back to the 25-year frame. Is this still the right position for my 25-year objective? In almost all cases, the answer will be yes. Fifth, consider having honest conversations within your family about financial planning. Understanding your family's financial situation, whether you might at some point be in a position to receive an inheritance, or conversely, what planning might be needed, allows you to make better decisions. Proper estate planning ensures efficient transfers and avoids situations where wealth is significantly eroded by avoidable costs and taxes during the handover process. Sixth, invest in skills that serve wealth movement. Whether through a career pivot or developing side expertise, understanding financial planning, real estate administration, or wealth advisory creates positioning to capture opportunity professionally as the transfer accelerates. The share of Millennial and Gen Z clients at high-net-worth financial firms grew from just 8% in 2021 to 25% by 2024. Advisors who understand how younger generations think about money are capturing business that will compound for decades. Businesses and careers in these spaces have a 25-year tailwind. Let me close with some historical context because I think it matters enormously for understanding how significant this moment actually is. The United States has experienced a handful of genuine wealth creation events in its economic history. The post-World War II boom created the first mass millionaire class through housing appreciation and market participation. The bull market from 1982 through 2000 created millions more as retirement accounts expanded and technology transformed the economy. The recovery from 2009 through 2026 nearly tripled the number of millionaire households as markets reached new highs and consistent investors were rewarded for staying the course. Each of these events minted millionaires who simply participated in economic expansion. No genius required. No insider access. No dramatic single moment of perfect timing. Just presence, patience, and consistency across the duration of the event. The Great Wealth Transfer is the next chapter. $124 trillion will move over 25 years. Economic activity will accelerate as that capital deploys. Asset prices will be supported. Opportunities will emerge across sectors, geographies, and professions. Millions of new millionaires will be created, and history will record this period as a defining wealth creation event, just as it has recorded the ones that came before. The question is never whether the opportunity exists. We've established that it does, documented by credible research, supported by economic history, and already underway right now. The question is always the same one. Will you be positioned to benefit? Margaret, the school teacher, didn't know in 2009 that she was capturing a once-in-a-generation moment. She recognized that circumstances had created unusual value, and she acted while everyone around her was retreating. She wasn't fearless. She wasn't certain. She was simply willing to act on information that was available to everyone. You now have the information. You understand the scale. You understand the timeline. You understand the specific actions that position regular people to benefit from it. What you do with that understanding, starting today, not after more research, not when the moment feels less uncertain, not when you've saved a bit more first, that is what determines which side of this wealth creation event you end up on. The window is 25 years wide. It is already open. And the best possible time to step through it is right now. I'm Miss Money. And I'll see you in the next one.